Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Tro, and today I'm just going to analyze the markets and talk about what's going on. First of all, Greek bond investors are rejecting a recent bond swap deal where they basically lose around 50% of the bond valuation, and until they wait for the bond to pay itself off over the course of 30 years and eventually pay off the whole principal amount at maturity, they're not going to see their investment. And the only way they will ever see their 30-year investment that has already devalued by around 70 to 80% from the inception point of those bonds, is if the Greek government is ever able to pay off the debt it has in the first place. And not only that, these Greek bond investors are also given lower interest rates and a longer term, so it's kind of, it's taking anxiety and spreading it over a long period of time. 10 years is bad enough as it is with Greek, but it's a whole other spectrum of issues when you're waiting 30 years, because we're not sure what's going to happen, much less over the course of 10 years, but we're not sure what's going to happen over the course of 30 years. So that 30-year bond has issues, because when you look at bond markets, the longer the duration of a loan, the more interest you're supposed to be paid. In this instance, the bond duration is extended with the interest rate being cut, all for the sake of the government perhaps being able to reach a budget surplus on favorable economic conditions, if those favorable economic conditions were to ever exist. That being said, this whole entire issue comes down to the way investments are priced. Investments are priced on a simple model. More risk equals more return. Greece is already a pile of issues, but now we're forced to accept lower returns, and even lower returns over a longer period of time. That's ridiculous. You're supposed to get a higher return on already a risky investment, and top that with the fact that that risky investment shouldn't be extended for 30 years with a cut in interest. See, a 4% interest rate is something you can get from a general, you get awfully close to it just by owning a tobacco company stock and earning the dividends off of it, like Philip Morrison. There are many compelling investment options, and I'm more than certain the investors in the Greek treasury bonds are very, very unsatisfied right now, very unsatisfied and very disappointed. That all leads to a lot of uncertainty in whether or not these two parties, these investors and the government, can come to an agreement. And for now, it seems they have not been able to do that, and therefore the dollar index continues to go up on the Euro-US dollar fear trade. Let's move on to the S&P 500. S&P 500 has pulled back, and this is the S&P E-mini future contracts in the overnight trading session. These have pulled back overall, as European equities have pulled back on average 1%, negative 1%, negative 1.23, even negative 1.5% on the German index, FTSE negative 1%, Nikkei Japanese index negative 0.63%, Chinese index Hang Seng negative 2.6% overall. Asia and Europe have extended their declines from yesterday, and now they're extending them even into Tuesday, Monday, Tuesday. Relatively weak trading sessions, and seeing as how extended the U.S. stock market has been for the past 6 months, I would not be surprised by a major pullback. That being said, the Dow Jones Industrial Average is a pillar of strength, because there's a lot of investments that you would hold on to over traditional stocks that are riskier. Perhaps, if stock markets were to pull back, you would still want to hold on to Coca-Cola, you'd want to hold on to Walmart, you would want to hold on to IBM. Those are the companies you would hold on to, because you're not in a hurry to sell them, and you'll know they'll do fine, just fine, whether or not the economy were to pull back, because they're non-cyclical investments and they represent a huge portion of the Dow component index. So those stocks are floating the market, are floating the index. But even so, in the past, I've seen time and time again, whenever markets correct, the Dow Jones corrects a little less, and the S&P 500 takes a huge brunt of the force. Right now, S&P 500 is pulling back significantly. Dow Jones not as much, but we haven't seen the Dow Jones Industrial Average quite yet on tomorrow's trading session. Okay, because we're watching the overnight action on the S&P 500, but we're not seeing the Dow component. Going back to the S&P 500 index, though, one thing I do want to mention is that when you trade the broad markets, what typically happens is that when the S&P 500 is going to open tomorrow at the 10 a.m. open, what you're going to see is a huge gap below that 20-day moving average that you see right here. And it would not be surprising for the markets to continue extending those losses because it's already gapped below 20-day moving average. There's no immediate area of support. People have already lost money, and one indicator you want to really watch out for is rising volume. If the volume goes up, that means that there has been a huge liquidity trap, but the bad kind that actually exacerbates and extends losses. So what happens is that when the volume goes up, typically what happens is the amount of people who own their stock are selling it in such huge quantities that the bids are continuing to drop, and the offers continue to drop with it, and therefore the price continues to rapidly decline across the board, and the weaker stocks, or the higher flying, higher beta, higher PE ratio stocks are going to do the worst, like usual. That being said, let's move on to the crude oil markets as crude oil continues to pull back. The thing I want to mention with crude oil, though, is that crude oil has not experienced any major geopolitical risks ever since its recent rally in the past couple of days or weeks. And for as long as the US dollar index continues to go up, chances are crude oil will continue to go down because stronger dollar valuations are usually weak and bad for the commodity markets. Just the way they work, that's how markets function. And therefore, you could anticipate more downsides, so as long as the US dollar index were to continue going higher, and so as long as major geopolitical problems in the Middle East don't continue to, or don't reemerge, perhaps something major like Iran or Israel going to war or something like that. But as long as we can avoid major headlines like that, crude oil will most likely continue going lower on dollar index strength and the overall dollar index to continue its upwards trend. Euro-US dollar is trading into the upper end of its channel, and it's been able to pull back from the 1.37 area. I've been mentioning this again from my previous videos. Same point here, Euro-US dollar should continue its downwards trend. Don't be surprised if it does. And overall, I see the area being 1.19 where it eventually finds support, and I see this channel continuing to go lower because it's, in a downward slope. That downward slope continues going lower, and eventually this line will intersect with this line, and hopefully the markets kind of trade into that intersection right there between these two lines, and that will probably lead to a great opportunity for you to buy the markets. And to give you a quick example, this is what I'm looking for. And I eventually see the stock price perhaps going in, down, up, down, and eventually it kind of goes, I guess I should change that trend line a little bit, but it's probably going to look like something along the lines of this, kind of draw on another line, goes up a little bit more, then eventually it bisects between these two lines, both the 1.2 and the downtrending channel line right there. So that's kind of what I'm anticipating in the Euro-US dollar. Euro-Japanese yen is also on a continued downward trend, and it's going to remain that way for the past. It's been that way for the past couple of 5 years. And basically, this is the risk trade. Japanese treasury bonds are seen as a very safe category of assets, and that just leads to the European safety trade where they sell their euros and they buy Japanese yen, and then they buy Japanese treasury bonds. Even though you get a 1% yield, the advantage of owning them is in the currency pair, where a weaker euro, when you convert those yields back into the European currency, you add that yield valuation or that appreciation, and eventually it makes up for that really low interest rate you get on treasury bonds in Japan. Moving on, silver is on a continued downward trend, and same thing with gold. It used to be that people would buy on any sign of dollar weakness, Okay, so weaker dollar is great for commodities. Commodities used to jump on that. But right now, ever since the recent drop in both 2000, in the September drop and the May drop of 2011, now silver tends to pull back on any sign of resistance, any sign of weakness. Okay, it pulls back really strong. If, say, the dollar index were to go up by just 0.5%, silver would overreact and go down by 5%. In the past, when the dollar were to go down by 0.5%, silver would overreact and go up by 5–10%, stuff like that. So the mentality has kind of just switched and, kind of flipped a bit upon itself, and it's a completely different mentality going into silver. Before, we never considered the risk, we only considered the gains. Now when we trade silver, we only consider the risk and not the future possibilities. And not only that, silver and gold have both closed below that 200-day moving average on a closing basis, with 2 consecutive trading days below that 200-day moving average, both being more negative than the previous one. This is a continuation to the downside, no doubt about it. I would avoid silver. Volatility index is trading relatively flat to the Dow Jones Industrial Average, mainly because the Dow Jones Industrial Average is kind of peaking right now, and it has not had a significant pullback. Therefore, the volatility index has not been able to significantly rally, but I anticipate more upside in the volatility index in the near-term future. AGQ, leveraged silver ETF, I eventually see this thing continuing to pull back significantly by a huge amount, perhaps all the way down to that $48 area. Caterpillar stock running into a double topping pattern. I see this stock heavily exposed to slowing Chinese growth, and this stock is running into those previous tops. Immediately, it's a sell signal, and that is it for me today, guys. Have a nice trading session.